Happy Thursday, everybody. I'm Chihiro Kurokawa.
And I'm Pedro de Leon. What's going on, everyone? Happy Thursday. Man, it's exciting. The weekend it's coming. So today we have an amazing guest. His name is Tim Pawul and is a seasoned finance and business development professional with nearly 15 years of experience working closely with oil and gas executives and investors. He began building his expertise in the minerals and royalty space while leading the American division at the Energy Council. In 2020, Tim launched the Minerals and Royalties Podcast, which has grown in the leading content platform focused on this niche. So Tim and we got connected at a family office event a few months ago and was very interested to learn more about, the oil and gas industry. So Tim, glad to have you here. I'm excited. We want to learn. So yeah, chime in.
Yeah, no, guys, thanks for having me. And great intro. I'm fired up. I'm ready to go.
Absolutely. So Tim, tell us a little bit about yourself. What got you into the oil business, and what are you doing now currently, including your podcast?
Yeah, absolutely. Graduated from Rice University in Houston, wanted to be an investment banker, couldn't get a job. Buddy got me my first job, and I got into the oil and gas industry kind of through the back door, right? And always have had business development centric leads or roles, I should say. Have built a really robust network, first internationally, and over the last decade or so more in the US, primarily with private equity professionals, with investment bankers, and then the management teams of upstream oil and gas companies. So for those listening, you might know Exxon and Chevron, maybe like a Pioneer name, or Occidental. Those are upstream oil and gas companies. So over the years, started to kind of inch closer and closer back to that investment banking type role. And in 2014, the first publicly traded minerals and royalties pure play companies were IPO'd. One in Canada called Prairie Sky Royalty, one in the US called Viper Energy Partners. And that was when I first started my journey with the minerals and royalties asset class. I look at it as the beginning of the institutional era of the minerals asset class. So minerals, for everyone listening, there's oil and gas molecules in the ground that then get produced by Exxon or anyone drilling and extracting that stuff and selling it into the market. When those molecules are in the ground, there are rights to them. And those are called mineral rights. And uniquely in the US, individuals own those rights. Everywhere else in the world, governments own those. And so governments will hold bid rounds and tenders for oil and gas companies to go, and they call it production sharing agreements. Basically, give them the pleasure and the right to extract their minerals, and then they'll share the revenue stream. In the US, individuals own those. And so why that's super interesting, unique, is that there is tremendous amounts of wealth in these mineral rights, but they've been fractionated over the last 100+ years. So give you an example. If great grandpa owned a ranch in West Texas, had 4 kids, took his estate plan, put the minerals in there and said, I want to divide my mineral interests to my 4 kids evenly. Then those 4 kids had 4 kids. And then those 4 kids along the way had their own kids and maybe did a little horse trading. And you fast forward 100 years, and there's tens of millions, if not hundreds of millions of people that own these things, from as small as $10 a month to tens and hundreds of millions of dollars a month in revenue, to the biggest, right? And so for the longest time, this was really kind of small ball. Folks would buy producing royalties and think of it as a fixed income bond alternative type product. It kicks out distributions. It was fairly steady. This is conventional oil and gas wells. So the difference between, if for those listening who are not familiar with oil and gas, conventional is you drill straight down, right? So it's kind of like a layer cake and you're just putting a straw. But say in that layer cake is this really delicious, chocolate fudge layer that's thin. Unconventional drilling is putting the straw in and then bending it to go directly into the fudge. I don't want all the other fluff on the cake. I want to go straight to the fudge, right? So the analogy of the fudge in oil and gas is the source rock. It's where the most amount of oil and gas molecules are. And so you're basically just increasing that initial production at a much higher rate. Now, what happens is the reservoir pressure goes down very quickly when you do these unconventional wells. So to give simple math, 60 to 80% of all the oil and gas that will get produced in the life of an unconventional well that may be online for 30 years, 60 to 80% gets produced in the first 18 to 24 months. So in financial terms, that is a very front-loaded yield investment profile. On top of that, a conventional well might cost $500,000 or $1 million to drill and complete and bring online. An unconventional well can be $8 to $20 million, right? So when you look at the front-loaded yield nature of unconventional wells, and you look at the scale of dollars needed, you add those two up, and institutional investors now become interested in minerals because now they can deploy hundreds of millions of dollars and get private equity like returns of 20% plus, which is what they need. And that was kind of the birth of the quote unquote institutional era of the mineral space in 2013-14, the formation of public companies, pensions and insurance companies coming in, and then private equity and putting big dollars to work. And so teams started to form to put Humpty Dumpty back together again, right? All these fractionated interests I'm talking about, just going out and calling 1,000 mineral owners to ultimately do 10 deals and just continue to do that day in, day out, build a portfolio, and then collectively that portfolio would give out a certain amount of yield, would have a certain amount of new yield coming on from new drilling, and then a bunch of undeveloped acreage for long-term upside. And you kind of not too hot, not too cold, just right blend that institutions want. They're building these portfolios and then selling them up the food chain. So like in any other industry that has active M&A, there's a daisy chain of tiny fish gets eaten by small fish, medium fish eats small fish, large fish eats medium fish, right? And so the mineral space has all these different actors doing that, but that ecosystem didn't really exist prior to 10 years ago. So I just happened to be there when these first IPOs came out. There's probably 6 larger funds that had just popped up from private equity. So the space is, for the most part, it's not really a space. It's a couple of companies. But I was just fascinated with it. And I kind of went down the rabbit hole of, hey, this is interesting. Capital markets like it. Who else does this? What else can I learn? And that started with, at the time, I've always been an industry connector, know a lot, mile wide and inch deep knowledge base is how I started my career. Know a lot of people, know a little bit about what everyone does, connect the dots and help facilitate things. And so when I was at this prior company, I would just go to these early funds, folks like Haymaker Minerals and Rivercrest Royalties, which is now which is the predecessor of the public company Kimball Royalty Partners and Phillips Energy Partners and folks like that, Noble Royalties. I go, okay, guys, who backs you? How much money do you have? Where are you buying in the US? How are you buying? What's your secret sauce? What's your strategy? What's your fund structure? How are you managing these things? I was asking all these very specific things criteria-wise to this space. And I had no end goal in mind. I just was intrigued. I don't know why. It's just sometimes in a career, you look back and you go, I don't know why I decided to go that way, but I'm glad I did, right? And so 2015 came, and now there's a dozen more companies. And then 2016 comes, and there's 25 more companies. And along the way, I would go to every company. Hey, where do you buy? How do you buy? Who backs you? And I started tracking this stuff. I call it my minerals brain. It's a spreadsheet on steroids I've been building for over a decade. And it just kind of keeps me in the weeds on all of the activity of what people are doing and how the puzzle pieces fit together. And so that, you fast forward as I continued to do that, this space was growing and I was just along for the ride. but I was uniquely positioned as, from the beginning, of someone who was like in touch with everyone, learning all this criteria. And this is not readily available information. It's a very, um, you know, information asymmetry space. This is why the returns are really compelling. And that goes across all fronts. There's a lot of imperfect data, in terms of just the market that I play in, which is kind of the secondary market of helping broker deals and raise money and everything. Even company to company, there's a lot of information asymmetry. So, a lot of the intel and the relationships I have, you can't buy it, you can't download it anywhere. It just came from beating the pavement. And so it put me in a really unique spot. Going into 2020, there was a shift. So in the beginning, it was, let's try to build a company and go public. Let's get backed by a pension fund or insurance company. Let's get a commitment from private equity. And then the shift came to, hey, we need to go get our own fund together. Private equity has already picked its portfolio companies. We need to go raise from high net worth individuals, from accredited investors, from family offices, and we want to do a $10 million fund or a $30 million fund, whatever it is. And so there was a shift there. Reg D offerings, go out, non-registered securities offering, go raise that money, and then go and deploy and build these portfolios. So I, as a connector in the space, got a lot of questions. Hey, Tim, do you know of any investors? Do you know of any family offices? These are the intros that would really be valuable for us. This is the next chapter for our team. And those were not my core background. I knew a lot of investors, but it was established funds. It was either energy credit funds or energy private equity funds, or the energy teams within institutions, hedge funds and asset managers and things of that nature, not the limited partners, the investors behind them. But that was what was needed. And so I kind of sat back and I said, okay, how do I build these relationships, leveraging the position that I'm in versus just going out and kind of beating the pavement and knocking on doors? And the consensus I had after some brainstorming was, let me produce content. This space has no content. If I'm an investor and I want to learn about this space, I hear about it from someone, I get invited into a club deal, and I want to go do a little bit of due diligence before putting my money forward. You literally couldn't find anything. It was like a couple of presentations from the public companies, but public companies act and behave extremely differently than small private funds. They're playing two different games, right, within the same asset class. So that was the start of my Minerals and Royalties podcast. The thesis was, I know every CEO, I know a lot about this space, and let's just BS about deal flow and investor sentiment and everything in between related to minerals. And so I launched it to educate investors on the minerals asset class. And there was no one else out there, so I was picking a lane. It was very narrow, but I said, if anyone wants to learn about this space, they should stumble across this, and they can build out my network. And then, after I launched it, COVID happens, content consumption goes way up, no one's traveling, and I got a little bit of a personal brand like boost out of the gate because of the circumstances. And after a few months, I kind of turned around and said, hey, this is really interesting. I'm in a unique spot. I have these amazing relationships. I have this podcast platform now. I think I can help a lot of investors and a lot of teams. I'm going to go start my own merchant bank. So I got my securities licenses, hung my own shingle. That's what Minerals and Royalties Authority is. And I've been doing that almost 5 years now. And I work a lot with investors, educating them, answering questions. And then, I just try to understand what they're looking to achieve. So listen, to the chagrin of my wife, I talk about minerals and royalties all the time, and she has to put up with it because she's my wife. But others don't need to go in the weeds and learn every little angle of it. They just need to know a little bit to be dangerous, enough to be dangerous, enough to get comfortable. But then at the end of the day, it's diversification into something to achieve a return. And so, what check size are you looking to write? Are there certain structures you prefer? Like, I want to be in a 3-year fund term versus a 7-year fund term versus a 10-year fund term. I want something that generates distributions right away, or I don't need income right away. I want something that compounds and grows, and I'm really looking for an ROI, a return on investment, a multiple. I have a view on natural gas versus oil. I want to be in a fund that is really big, and I just want to go along for the ride, and I want to know that there's a large institutional investor that's underwritten. I want to follow their coattails, or I want to be in a smaller fund. I want to be with young, hungry guys who have skin in the game. And so, like, asking just very simple, basic questions that every investor will be able to answer on what they're looking for. I then reverse engineer that into, hey, these 3 teams do this really well. Exactly what you're looking for. Let's go meet them. Let's get to know them, hear their decks. And, if it all works out, you can partner with them and put capital to work. So that's what, and so as a result of that, I was the night we met, I was with a family office that is in the oil and gas mineral space that I'm very good friends with. And I travel a lot to LA and New York and Palm Beach and Miami and Atlanta and anywhere else that there's large kind of family office concentrations. And I'm just kind of hanging the hat on, I'm the sector specialist for these asset classes. I know more than anyone in the world, on the weeds of this stuff. I'm confident of that. And I'm continually out there speaking with groups and keeping that knowledge base fresh. So that's kind of the high level overview. And I'm happy to talk about, minerals rights in granularity, but over to you guys for questions.
No, absolutely. I do have a couple questions. I'm sure Shihiro does. The one thing I want to add is, so in 2018, the closest thing I've done, I got hired in as a investors relations for a company that was looking to buy. I don't know. I don't consider land because they were leasing it, but the rights for the oil in Bakersfield. It was a small little pot of land in between these big giant companies, California.
Resource Corporation.
Yes, correct.
PRC.
And I had to do some quick, go to school, trying to figure it out, understand the industry, because I was helping them raise capital and then the need of that arm, the department, and I literally learned so much, but there was so much lack of information in that space, which is because what you brought up, right? Like you decided to bring this up and start your podcast. Yeah, and I had so much difficulties, and I was making calls and trying to talk to people that had some sort of knowledge in the industry. So yeah, but I went to town and I learned a lot. Unfortunately, this company wasn't able to move forward with some legal issues. But yeah, Bakersfield, and I went out there to the fields, and that was a pretty cool experience. But that's my knowledge as far as working in that industry. So
yeah, so you're a perfect case study, right? So this is before I started producing a lot of the content, and I'm the main content creator for the mineral space. So I'm sharing news updates. I have a newsletter. I do podcasts. Doing a webinar later today. Just and I repurpose a lot of that. Video clips and commentary and all that. And it's just if you want to get plugged into what's going on, you can come to my LinkedIn page or any of my platforms, and hopefully it's everything you need, right? And it's all there, whereas it wasn't before. A lot of people, this doesn't come up as much, but you say minerals and people go, oh, palladium and germanium and hard rock minerals and critical minerals. And yes, those are minerals. These are minerals as well, but oil and gas minerals in the U.S. And that's the specialty I have for sure.
Yeah. I have to ask you this question, Tim. So I know in fracking, you're going horizontally, potentially multiple thousands of feet. So how do you make sure that you're not crossing paths with the driller, in the adjacent plot of land? So and if that happens, how do you resolve that dispute?
Yeah. So here, just taking a step back, what's beautiful about Minerals and Royalties is that you do not have cost exposure and you're not involved in the operations. Now, some people view that partially as a negative because you don't have control, right? So you're in the back seat of the car and you can't tell the driver where to go and where to turn. But at the same time, you're not responsible for the drilling of the wells. You're not paying for the drilling of the wells. So here's a real estate analogy. Let's just say, the three of us buy into, as a partnership, buy into a hotel, right? And now we own the hotel, and we own a proportionate share of the revenue stream coming from room rentals, and there's maybe some weddings that get hosted there, and there's we're part of the operations, right? And now they're going to have overhead and other things. You have to fix up rooms and broken toilets and all that stuff, and so you participate in that as well, and you get part of the net profit if there is one. Now imagine if the operator of the hotel said, it's currently 10 floors, but we want to add another 10 floors, and we want to do penthouse suites on the top and sell it to corporations. And the capex for that is going to be $300 million, and we think it's going to project another $500 million in revenue, $200 million net profit. Well, in an analogy, as a minerals owner, if that was an oil and gas company building more floors, i.e. drilling more wells, you don't pay for that capex. You don't pay for the improvements. You don't pay for the labor, for the insurance, for any of it. You just get a portion of the revenue stream. So that becomes really attractive for a couple of things. One, if I'm investing into something, the black hole money pit, of a private investment is always a concern to someone. Hey, I'm not an expert in this. I see the plan and the projections in this asset class or industry. It all sounds great, but then what if something happens and the management team turns around and said, "Oh, we need a little bit more money for this, or a little bit more money for that," or a COVID happens and now the company goes bankrupt, or what have you, right? They get over levered. With minerals, you don't have to worry about any of that. So after you buy in, now it's just time value money of your future cash flows. And if whoever buys in does it correctly, and they've done their homework on trying to project out when new wells will get developed and all that, you just start to realize this upside over time, and it's just, they call it mailbox money. You just get a royalty check in the mail. You don't owe any expenses. And so for people out there looking for distributions, looking for yield, minerals and royalties are a great investment. Now, the other thing that's really compelling about the non-cost aspect, so no capex, no opex, is that these investments act as a hedge on inflation of the rising costs of energy. So what does that mean? And it's particularly relevant right now. I mean, the US dollar is incredibly inflationary. We're living in an environment, everyone goes to the grocery store, everyone knows. You could look at the CPI and all sorts of other, inflation indexes. They're all honestly gamed,
Right.
but for whoever's reporting them. The truth is the spending power of our dollar is going down every day. And a lot of that is the amount of money that was printed in COVID, 2020, 2021 alone. I read something, I'm quoting this from a book I am currently reading called The Big Print by Lawrence Lepard, but 40% of all US dollars in circulation were printed in 2020, 2021. Think about that. Like, wild. So, the value of our dollar is going down. And so what happens is it just becomes more and more expensive. More and more dollars are needed to pay people, to get equipment, to operate things, all that. So when you translate that into the oil and gas space, if I'm Chevron and I'm looking to drill wells, well, I got to pay my people more. It costs more money to get a drilling rig. It costs more money to do all these things. And so inherently, the break-even cost of producing a barrel of oil goes up. Now, in an inflationary environment, typically commodity prices go up as well. So I'll give you a simple math example. If oil is $60 a barrel and it costs $50 to produce that barrel, it's a $10 margin, right? You get, let's just say you own a 10% royalty. So now you get, 10% of $60 per barrel. So $6 a barrel. If the costs go up because of inflation, and now it's $70 a barrel of cost, but the price in the market is $80 a barrel. It's still that $10 a barrel margin for the operator. So if you're on the operations side, it's still $10 of margin. On the royalty side, you're getting 10% of $80 a barrel. So you're getting $8 a barrel for royalty payments, not $6. So in an inflationary environment, you're making more revenue and you're not contributing to the cost. So that's where when people say that's a very simple example. Inflation is complex and there's a lot of moving parts, but that's just a very simple way to think about why minerals and royalties are an inflation hedge. And that's valuable because you want to have things in your portfolio that are more growth oriented, some things that are more stable in yield, some things that give you inflation protection, like building a diversified investment portfolio. These things are important. And so when I work with a lot of investors and family offices that are strategically kind of crafting a portfolio together to fit these different elements, minerals become a really attractive option for that, for sure.
I do have a question. Well, actually, two questions. With all that, when it comes to investing in any kind of asset class, what are some of the red flags as an investor should be aware of before investing in a team or a fund?
Yeah, I think anything that feels super promoty, I listen, like the role I play, a lot of times, anyone listening. So if you're looking at investments, you can call me and I'll tell you if it's a real player or not. Right. So if there's going back to the daisy chain of like small fish eats, tiny fish, medium fish eats small fish, that type of analogy, in the capital raising world, if someone's kind of promoting you to then flip to someone else, I mean, ultimately you want to cut out as many middlemen as possible. So that just in terms of like making the best investment, it's trying to get as close to the source as possible, or whoever, when you look at the G&A of the team and the net efficiency of how they're buying and managing a portfolio, whoever's doing the best job of that and getting the best returns, right? You want to go with someone who has a good track record, has all the right disciplines. And so if there isn't really much out there on somebody, or they don't have a track record, or I'll say this, the general return profile for a minerals asset, when it's producing, right, and it's just a production stream and it's giving you distributions, typically a discount rate of 10 to 15% is kind of what those assets are worth in the market. When you start going and blending in undeveloped acreage, so it could get drilled in the future, that discount rate will go up maybe to 30, 40%. And then when you have there's some signals in the market that wells might get drilled sooner rather than later, regulatory filings and permits. So it's an intent to drill in a location. An operator will go and file a permit, and then they actually start drilling. And these are referred to as DUCs, DUCs, drilled uncompleted wells. So first you have to drill it, then you have to complete it, and then you have to bring it online. So when you have permits and DUCs in a portfolio, the discount rate will typically be between 15 to 20%. So companies are building portfolios and blending that all together. In general, 15 to 20% IRRs is kind of where the mineral space lives in, right? If someone's promising you 30, 40%, returns, potential red flag. Can it be done? Yes. You need the right tailwinds of commodity prices going up. You might need to time, an exit correctly, but you never want to put all your eggs in the basket of like everything working out in order to get a return. So if someone's proposing, projected returns in that range, and then over the life of the investment, something around a 2x ROI, that sounds about right. That smells about right. The other thing to look at is the fees. So are you aligned with the investor? Is the investor getting a ton of compensation up front without performance, and then also backing into performance? So there's a lot of different ways to structure it. The kind of down the middle of the road structure is you pay a management fee, typically 2%, and this management team that helps them pay salaries and software subscriptions and just the day-to-day activities of running the fund. And then they're going to go and they're going to aggregate a portfolio, and they're going to pay you a pref rate of 6 to 8%. So what that means is, hey, you're using my money, and until I make all my money back, you're going to give me 6 to 8%, cost of using my money, almost like an interest rate that you would pay a bank, right? And until you get me all my money back, so if I make $1 million investment into a fund, until I get $1 million back plus 6 to 8% preferred return, compounded annually, then what's called the waterfall or the back end will kick in for a management team. So standard is somewhere between 20 to 25% typically. And that just means, okay, investor, I've made you your money back. You've gotten your preferred return. Now we're in the green. We're in the profit zone. And for every dollar that's made of profit, I want to take 25 cents and I'm going to give you 75 cents. And that's where, a really good management team is going to be in it to crush it. They believe they're going to outperform the market, and they want to participate in that upside, right? If someone is just getting all their compensation up front, they can underwrite an asset, be a little more aggressive, buy it, outpay everyone. They're going to get their compensation, and then maybe the asset isn't going to perform as well for the investors because you're not aligned, right, for the long-term performance because you're getting compensated up front. An answer to that, just if someone wants to go with a broker and say, hey, you're not in a fund, but I want to own these minerals directly, and I want you to go buy them for me. Well, yeah, the broker's not in a fund. The broker's getting paid to originate it. Mm-hmm. You're going to pay them a fee up front, and then you're going to own it directly, and it's up to you how it returns. So, but in general, if you're looking at it, I always say if you're not an expert in this, there are people who are eating, breathing, and sleeping this stuff 24/7. They have engineers, they have geoscientists, the databases, proprietary information, just IP on how to do this. Like, you're competing with them every single day, and they're looking at, like I said, if a fund buys 50 deals, they're looking at 5,000 deals. So if you're going to try to do it on your own to save on fees, and you're not sophisticated enough to really know what you don't know, that I would caution. Everyone can do what they want to do, but I would caution that because the other benefit of investing into a fund is a financial phenomena or strategy called cost averaging. So you could say, well, Tim, when's a good time to buy? Is it when gas is low or gas is high or oil is high or oil is low? The reality is it's not straightforward. Sometimes the best buys can be when commodities are lower. Sometimes it could be when it's higher. It all depends on the situation. So that's number one. Value can be created at all times. Number two is, how do you know when it's like super high or super low relative to where it's going to go the next day? No one knows. And so if you're doing one transaction at one moment in time, this is called pricing risk and timing risk. Cost averaging says, if I have $1 million to spend, I'm going to spend it fairly consistently over a period of time. And if oil goes up and it goes down and it goes up and it goes down and it stays flat and then it goes way down and it goes way up, I'm buying all along that price curve. And so theoretically, statistically, there's economic theory around this. You mitigate a lot of your risk because you're buying along the way versus trying to time it and buy at the bottom or sell at the top or any of that. So a fund inherently does that. Because everything is so fractionated, you have to buy that way if you're originating, at the wholesale level. And so that's one of the benefits outside of expertise of partnering with a fund, because they are going to build in a lot of downside protection for you just by nature of how they're going to build it. You have a question?
No, I was gonna say with that fund. So typically, what is if someone wants to invest? What is the minimum or that they can work with a fund? Invest into a fund.
Yeah. And by the way, I should have said this earlier. Like, this is for informational purposes only. Like, please consult an investment professional. I'm just trying to help everyone out here. So this is not a recommendation on what to do, anything I say here. But minimums typically, so funds will typically be 10 million to 150 million in size for the mineral space. Whereas over 100 is starting to get a little big. There's only a handful that are 3 to 500 plus in size. Most of them are around the 30 to 50 range. So just to set context for scale, that's number one. Number two, the minimums usually are in the $250,000 to $500,000 range. If you're going into a smaller fund, like a friends and family fund, it's $5 million. Likely they'll take smaller checks. One of the reasons why minimums will be a little bit higher is because there are reporting requirements that get triggered when you have, with the SEC and FINRA, when you have over a certain amount of investors. And so if I'm raising as long as it's all accredited investors, right, it should be fine. But if I'm raising a $50 million fund and everyone does $100,000 check, I start to trigger different thresholds that require more reporting, which equals more headaches, more cost, more things on the regulatory side. So that's one of the reasons why you kind of set these thresholds. Back to red flags, I would say if someone is saying you can put 10,000 in as a minimum or 50,000, that is something, hey, maybe that's the amount of money I want to put in, right? And that's the comfortable level. But just know that a lot of the established funds don't have minimums that low. So is this someone trying to promote and take advantage of less sophisticated investors? I think it's worth doing your homework and figuring out who this team is if they're offering dollar amounts that low, for sure.
Interesting. It's good to know. Yeah, definitely. So Tim, definitely this is I think that we can definitely have a class, like a breakdown workshop on this, and then just it popped in my mind because this is definitely an asset class that we're not familiar, or at least I'm not familiar with, but it's something that will be interested for most folks. And if you guys are watching this, if you guys are interested, let me know, or Shihiro know, and then we can definitely put a workshop in about this, right? So, and I know for a fact that when it comes to the space of investing in oil space, there is a large amount, like a big check, right? 150,000, 200,000, not the minimums. The minimums I've seen, 50,000 has been either startup companies or working in multifamily investing. I mean, I'm sure you've seen that too, Shihiro, the minimums, so it's definitely good to know the red flags. And the reason we emphasize a lot, like what some of the red flags is because this is exactly what have gotten a lot of people in trouble and also have lost their money because they don't know, like, I don't know how to spot the red flags. So what's the industry norm as far as like the minimums of putting into an investment, so, but definitely.
Another thing to mention I don't know if it's red flags, but it's just something to be aware of is concentration risk. So concentration risk, putting all your eggs in one basket, whatever analogy you want to show.
Mm-hmm.
You want to make sure if you're investing into something, they have enough diversification in their portfolio so that you're protected amongst the unknown. So let's just say you're investing into something and say, okay, we're projecting a 10% yield in year one, and it's going to go up to 15% in years 2 and 3. And you go, great, that's the kind of yield I want, right? But if it's coming from one well or 3 wells, what happens if something adversely affects those wells, or the wells underperform, or something goes down in the pipeline around those wells? Just there's a lot of things out of your control. And so statistically speaking, you're very exposed. And now your 15% yield can go to 3% just because one well underperformed a little bit. So when you go into a little bit larger funds, they might have 90 wells that are producing, and they might have 100 upside locations. Not, hey, I have 3 upside locations, and you kind of put all your eggs in one basket on if the upside is going to convert. And so statistical significance is an important part of this game. And it, on the back of that, and I think for folks listening here, going back to red flags, I also specialize in the non-op working interest asset class. And I want to touch on that because there's a lot of tremendous tax efficiency advantages of non-op. And there's a lot of promoters out there, and you need to be really careful. And guys that will go, down market. And traditionally, a lot of folks in that space will, go and put you into like very risky drilling, right? And a lot of concentration risk will be like 3 wells or 5 wells or whatever. And the tax efficiencies I'm referring to, and I'm not a tax specialist, so I'm going to speak high level. So if any of this is compelling, you should definitely get with your CPA or someone to assess your personal situation, because the state you live in and the type of income you have, it all matters. But there's something in the tax code, and this is not new, and I don't believe there's huge risks on it going away because it's been around for over 100 years. It's called intangible drilling costs, what's referred to as IDCs. And it basically is set up to incentivize oil and gas companies to drill in order to provide cheap energy for the United States. That's kind of the origin of it. And so IDCs say you can write off the costs associated with drilling and completing a well against income, right? And lower tax exposure to the tune of, typically when you add the depletion of oil and gas wells as an allowance as well, typically somewhere between 70 to 85% of costs. So when you go into a fund or a project that is actively drilling wells, you can offset 70 to 85% of the costs. And the general rule of thumb is for income that qualifies, you'll get 33 cents back as a cash tax benefit on every dollar invested before return is made. So if you're looking to just lower tax exposure, oil and gas has always been very attractive. Now, there's different types of income. There's passive income and there's active income. Active income would be your W-2, right? What you make if you work at a company. Passive income would be royalty income, right? So if you have royalty income off of oil and gas royalties or any other type of royalty kind of passive type of income, these can be offset by IDCs. If you have passive income, you can participate in a fund as a limited partner, right? So you're not in control of the management. You're investing in the fund, and those IDCs will pass through to you to offset passive ordinary income, which is amazing. Now, most folks won't have massive portfolios of passive income. It's mostly, hey, this is what I make this year. This is what I owe the IRS. I would love to lower that. A typical strategy for a lot of folks, if they have a 401k, is to contribute and try to max out a 401k to lower their taxable exposure, right? That's one thing you can do to lower it on your W-2. For oil and gas projects, historically, it's been you have to participate in the drilling like actively as part of the general partner or part of the management team. And so what's happened in the past is, and I'll make up an example. You guys have a friend, Bob, in Dallas, and Bob's like, hey guys, we've done a couple of good investments together. My buddy John worked for Chevron for 30 years, and there was this asset he always loved in Louisiana, and it was too small for Chevron, and he knows everything about it. He knows the seismic, and he's done all the land work, and now that he's retired, he wants to go back and he wants to drill it, and he knows exactly what to do. And this guy's good. We can trust him. Like, he just needs to pass the hat around, and he needs to raise $9 million, and we're going to drill 3 wells. And if it goes well, he thinks we're going to make 110% IRR. And you're like, wow, right? And we get the tax IDCs. And you go, wow, this could be a home run. And sometimes it is, right? But 3 wells, huge concentration risk. What's going to happen? The price going to go down? Cost inflation goes up. The wells get delayed. Something goes wrong. Like there's all sorts of things that can go wrong. And all of a sudden that 110% IRR can go to 10 or 0, like really quick. And so there's, the stereotype of like the boom and bust oilmen, the rags to riches and back to rags, like all these things you've heard of over the years is kind of like that phenomena of what I'm talking about. And you're always like letting your dollar ride on the next big success or big failure. Non-op funds are new, so Minerals institutional era started 2013, 14. Non-op is like 2018, 2017. And so the phenomena of having a non-op fund to go and aggregate, what is a non-op interest? Non-op interest is minority interest in a drilling operation. So there's 100% working interest, which stands for your exposure to the costs in an oil and gas operation, right? Let's just say Exxon's drilling it. Exxon's going to have 75% working interest. You guys might each have 5%, and I have 15%. And collectively, all of us are the working interest owners in that field. And we also have proportionate royalty interest as well, right? So we can get our piece of the royalty income. But there are funds now that go and they aggregate all these tiny interests. It could be 0.01%, 3%, what have you. Same thing as minerals. A little bit of a different game, but pretty similar. The reason these funds there's a need for them in the market is because of ESG. So the big environmental pushback, and it's really, the pendulum has swung the other way. And I think people understand the need for oil and gas. But back in 2014, 15, a lot of Canadian banks, a lot of European banks all pulled out. Hey, we can't lend to hydrocarbons anymore. And oil and gas drilling is billions and billions and billions of dollars of capital every year. It's very capital intensive. So you have huge amounts of debt, traditional debt going out of the system, right? Then you have university endowments and pension funds, folks that have stakeholder bases that are sensitive to these environmental, issues in the ESG movement. Call it a school in California or, something like that. They made the claim, right, to appease their stakeholders, no more hydrocarbon investing for us. So now you have huge amounts of equity capital running out of the market, creating this huge void. And so on the equity side, and then partially on the debt side, these non-op funds have been formed to come in and be capital partners alongside operators. And what it ultimately, going back to the concentration risk for an individual investor, now you can participate in the drilling of these wells and have a team build a diversified portfolio for you, right? Diversified by area, by operator, by well count, by, going back to the cost averaging. They're going to be buying into these wells, and these wells are going to be drilled and coming online at different times over a 1 to 3 year period. So you're mitigating pricing risk. They're also going to be professional managers. So they might be able to utilize things like hedging. So you can kind of lock in returns. And so non-op investing is completely transformed. It's very different than it used to be. And so if going in and getting IDCs to offset passive ordinary income and getting great returns is of interest, non-op is a totally different game. It's very interesting. Now, there's another structure that enables you to participate in a fund but offset active income, i.e. W-2 income. And it's referred to as what's a GP flip. So these are traditionally funds that are evergreen in nature but are open for the calendar year. So call it a vintage, 2025 drilling fund. And what you do is you actually participate at the GP level. They drill the wells and you capture the IDCs, and then you revert back to being a limited partner for the duration of the fund, for cash flow and everything like that. And so, there's some groups out there who do that. I won't name names, but there are some that are better than others. The challenge with that space historically is there's lots of fees that are baked into that, right? Folks are going out in the broker-dealer channels and the advisors, and it takes a lot of this stuff is, because of the tax benefits, they're going to individuals, accredited investors, high net worth investors, and fundraising is a slog, right? And so one of the other reasons why minimums are $500,000 typically in these other funds is, hey, ideally, if I can get a guy to write a $5 million check, that's better than 10 guys, right?
Yeah.
Right. And so it's just effort, network, management of all that. And so if you're going to raise 50 million or $100 million with $50,000 checks, you kind of need an army of people typically to do that, right?
Yeah. There's definitely a whole different level when it comes to and that's a whole different expertise when it comes to raising capital, and we can talk about that forever. But Tim, I do say that we're coming to an end right now.
Okay.
I think this is definitely we need to turn this into a workshop. So if you guys are watching this, let us know, because this is very interesting stuff that I really enjoyed.
Super interesting. Yeah. I asked 0 questions, but I actually have 100 in my head.
Yeah, and we can go on forever, so let's do this, Tim. I'll get some feedback from the community, and then from there we can definitely set up a workshop. But I think this is something that we definitely need, so Tim,
happy to help, guys. Happy to help.
Yeah, definitely. So is there any way where you have a website or so podcast that people can come and listen to your channel?
Yeah, for sure. So a couple of things. If you go to my LinkedIn, just Tim Powell, Pawul, look at my wall and my post history. There'll be a lot of daily comments and posts and different types of content you can consume.
Mm-hmm.
If you Google Minerals and Royalties Podcast, it's on all major podcasts, Apple and Spotify being the primary ones. That'll show up. I do an episode about every week with a different CEO, so you can check that out. And then if you're interested in just having a private conversation, you want to learn more, my email is tim@mineralsauthority.com. Like I said, my role is to be a guide and to help educate. And so I'm happy to do that. If you have specific questions on, really kind of leaning in and learning more, don't be bashful. I'm happy to help. So you can reach out.
Awesome. Tim, thank you so much for the insights. Glad we had you as a guest. If you guys have any questions, follow him on LinkedIn. Until then, stay tuned for the next show. All right, guys, take care and have a great weekend.